So the medical loss ratio is a rule and a law that's under the Affordable Care Act that says that an insurance company is required to spend 80% of the money that it collects in premiums towards the payment of medical claims and quality of care improvements. This is to kind of put some pressure onto insurance companies so that their costs can be managed a bit more. The intent was to put some legal pressure on them so that insurance and healthcare can be more affordable for Americans. Now, we can debate whether that's effective or not, but that was what the intention of the rule was. And so what I want to do in this video is model some scenarios as to what the actual implications of MLR are for an insurance company when it's structuring its plans, and then maybe speak to some of what I see as the financial motivations of an insurance company when they're pricing their insurance products, and deal with some things like how they negotiate prices with medical providers. So this calculator that you're looking at here on my screen, this is available online. I'll put a link in the posts where this is published, and when you click the link, you go straight to the calculator. So we don't hijack you with emails or those kinds of things requiring you to give us data in order to use the tool. You can just click on the link and feel free to use it as you wish. So what this tool is doing is it's intending to model the scenarios that an insurance company has to go through. And there's a little bit of an explanation here. You can read that if you want, but the short explanation is that an insurance company really experiences MLR in two stages. Stage one is what I would call the predicting or the forecasting stage. That's where they have to make a bunch of assumptions about what they think the enrollment experience, the medical claims experience, and even their own internal cost experience will be based upon the products that they're offering for the year. And then the second stage is they set those products up, they issue them to the public, and then they have the actual experience. And after the year goes by, they need to evaluate how close their actual experience was to the assumptions that they made in stage one. So this tool allows us to state some of those assumptions and then see what the effect would be. So the idea is, let's just say we're an insurance company, we're XYZ insurance company, and we think we're going to have, just to keep the number simple, 20,000 members enrolled on our policy. And so as you can see, when I update a value, the table values down here will update as well. So what we're saying is that's 20,000 people are going to enroll in our product, and that's everybody. That's employees, spouses, individuals, whatever. It's children. Every belly button is kind of a term I used to hear. So basically every member that's covered. And so the insurance company is going to cover these people, and then it makes predictions. So it uses the actuarial methods that their internal actuaries use to make predictions about what they think that these members will cost them, and they can usually break that down to a per member average. And so this tool right here, this slider, kind of tells us what it allows us to kind of simulate the idea of making those predictions. So we could say we think that each member on average is going to cost us $3,500 a year. And then we have an insurer cost factor. And what this means is it, and I should clarify, the predicted cost is the total healthcare spending of those members, and it accounts for things like the rate of consumption, how much healthcare, and if you could conceptualize this idea of units of healthcare that members will consume, and then the cost. So what is the average cost of healthcare services, and that can be a complicated concept. So we've just compressed it all into one slider here. And then we have a cost factor, and that's saying, okay, well, the insurance company is going to issue these policies that have member cost sharing arrangements built into them. So it's going to have deductibles and copay. So the insurance carrier is not going to be paying all of those predicted costs. It's only going to be paying a portion. And so we'll set it as a default to kind of the silver level actuarial value range of about 70%. So, but you can move it, and you can raise it, lower it, or you can increase it, and you can see the numbers change for you. Then we have an admin factor. This is just how much we think the insurance carriers internal administrative expenses are going to be. This is salaries for the employees that work at XYZ insurance company. This is marketing budgets and infrastructure, those kinds of things. It's always hard to kind of throw a dart at this one, but because it's going to be a factor of fixed costs and variable costs, obviously, but somewhere, let's say 5 to 9%, and we'll just say 8 because that's why not? Now the MLR target, I've put this on here so we can ask questions about alternative MLR structures, but the law says 80% for individual, market, and small group, and if you wanted to go to a large group, you can push it up to 85% if you want. As we move these sliders, you're going to see that we get these output values that tell us, okay, this is what we can expect. So you've got the amount of claims, and that's just running calculations based upon this data in here. And I don't want to explain every calculation, but those calculations are explained here. If you wanted to see that, I just spell out the math so that you can see how that's done. Anyway, restore our factors here. So what we have is based upon these values, and I think we had it at about 3,500 for member a predicted cost. It doesn't really matter; it'll scale. So what we're saying here is that based upon these assumptions, we would have expected claims of 49 million. So we're insuring 20,000 members, average cost of $3,500 per member. So the expected claims are going to be 49,000. That's, well, I'll explain one calculation. I guess that's expected members times the expected healthcare costs multiplied by the insurance cost factor. That's 49 million. And so what happens is the insurance company says, okay, we think that we're going to have an expense of 49 million. And so from that, we're going to calculate an amount that we think our premiums will be. And the premiums are directly affected by the target MLR. So if you'll watch here, as I just move the target MLR, you can see that the expected premiums change. Even though the expected claims aren't changing, that's because they're not going to be affected by MLR. The calculations that are used to determine the expected premium are based upon MLR. It's essentially a factor of right here. It's at 25%, and that's simply 100% divided by 80%. MLR is claims divided by premiums. So premiums are calculated as technically premiums divided by claims. And that factor, or you can just take the percentages. So 1.0 divided by 0.8, yeah, that's 125%. So that's how we calculate the expected premiums. And then we divide that out by the number of members, and we get a per member premium of $3,062.50. And then you can see, okay, here's our admin expenses, and this is our expected profit, and then our rebates, and then the profit less the rebate. And we're targeting MLR, so we should not be getting any rebates. This equation will always hold as the expected profit is the expected profit less the rebate in the stage 1 prediction. When we move to the second stage, what we're saying is, okay, well, we've got our prediction, and now we want to see how the actual year shook out for us. And the only real value that carries over from stage 1 to stage 2 is this per member premium. So what happens is the insurance company needs to file its rates with the state and federal government every year. So it goes through this process of making this forecast, and then it calculates a per member premium that becomes the contract premiums that they issue for their health insurance products. And they've got a way of breaking that out per product. This is actually aggregating all of the products together, but needless to say, they have this contracted premium amount, and that's the amount that they have to charge as premiums for the upcoming year. And so profits and losses will be based upon how that experience turns out. So just to run through a couple simple scenarios, if the insurance carrier were able to perfectly match its prediction, then we have 20,000 members, and we have expenses of 35,000 and admin costs of 8%. You'll see that the values are equal, where our actual experience matches our prediction. So this is where we can kind of play around with some scenarios and say, well, what if the insurance company didn't quite hit its target? What if it had fewer members in reality throughout the year? And you can see that the actual profit obviously goes down because they didn't have as many members. And then what happens if the actual cost goes up? And you can kind of see how the insurance company is going to end up taking losses on its profit there as well, or if admin expenses go up. Now, the question is, what if they have the alternate experience? What if they picked up more members than they expected, and costs were equal? Well, they're maintaining the same medical loss ratio because the spread between premiums and claims is the same, even though the numbers themselves are different, and the insurance company makes more profit. But what happens if actual claims costs go down? Well, if the claims costs go down, let's say they predicted $3,500 per member, and in reality they and just to keep the side by side going, let's make it side by side. So they have this. They predicted the members correctly, but they overestimated claims. What happens? Well, the insurance company initially sees a higher profit. They've almost actually doubled the profit, but they have to issue rebates because their MLR ratio was higher or was lower technically than what the law requires, and so they have to issue the rebates in the amount of about $7 million in this case. And so the insurance carrier's actual profit is still fixed at the optimal case of the forecast. And so you can see that the real advantage to an insurance carrier right here is to nail the forecast correctly. One of the things that comes up a lot when we talk about MLR, I hear a lot of brokers say this, that one of the things that an insurance company might do is they might go to their medical providers, their doctors and hospitals, and try and negotiate for higher expenses. And the reason they want to do that is because they can increase their profits if the medical providers charge more. And so there's kind of this idea that there's this this underhanded move by the insurance companies to charge higher prices. And there's two ways to approach this. One is the model, the other is to actually look at the hard data. And looking at the hard data is a little bit more of a difficult task, but when we do that, I actually don't see that quite as consistently as the arguments I hear would suggest. But let's go ahead and just model that. We'll just take a look at it here on the slider. So let's say an insurance company said that we want to well, let's start here. Let's keep the math easy for our heads. So let's say that the insurance company predicts initially $3,000 as the per member expense. And they say, well, we want to pad that. We want to increase that by 10%. So if they increase that by 10%, you can see that their actual profit does go up. It is true that if they increase the cost and the ratios, the way that premiums are built off of a ratio of expected claims, the expected profit does go up. And so as you can see, we're here at $6 million as their profit if they pad it by 10%. And if we go back down to the, let's see, was that 10%? So 3,300 would be 10%. Yeah, that was 10%. So if we go back down here to the 3,000 mark, the insurance company made about was it 300,000? Yeah, 69. So 600,000 in additional profit. So 6.9 million versus 6.3 million. And so you say, okay, well, clearly there's this motive to do that. But here's what we discover when we look at that. What if we just said, okay, let's keep the cost the same, but the prediction of expenses the same, and negotiate the true price, if you will, of healthcare. And I know that's a messy concept, but just trying to keep things somewhat simple. Let's increase our estimated members by the same amount, by 10%. And as you look at that, when we increase our membership by 10%, so that's 2,000 additional members. the expected profit is identical to the expected profit if we increase the cost by 10%. So, and that makes sense when you understand the way the formulas are calculated, but that becomes an important point because what it shows is that there's two directions where the insurance carrier can achieve the same profit. One is to increase membership, the other is to jack up prices. But there's one thing that's not too obvious until we look at more details, and so what I want to do is restore our base scenario. And under this case right here, our base scenario, so a profit of $6.3 million, the per member premium is $2,625. Now, if I increase the predicted cost by 10%, oops, let's get that there, fine tune it. Okay, we're back to our 6.9 in profit, but our per member premium is $2,800. So it went from $2,600 to $2,800, almost $2,900. So that's almost a 10% difference in cost. In fact, just to pull up a calculator here real quick and take a look at it, just because I'm finicky about the numbers. So 2,800 divided by 2,600. Yeah, so that's a 7% change in the cost, and as most of you brokers know, that's enough to make a purchasing decision for an employer group or even for individuals. They'll move plans for a 7% price difference. Now watch what happens if we just increase the membership, and you can probably guess. But if we increase the membership, our premium stays the same. We're still at this $2,625. So the implication of that is that if we increase the membership through better services or those kinds of things, the carrier actually sees a higher profit, because if we're going to increase the provider negotiations to the 3,300, then we also have to kind of anticipate that maybe we're going to see a drop in enrollment. So let's drop the enrollment by 5%. And now you can see that the insurance company is actually making less profit than it would have made had it just stayed where, if it had just chosen to make the products more attractive and increase membership. Let's also suggest that the insurance company might increase membership, but also it's going to make the product slightly more attractive, so they might have an additional cost. So even if it increased the cost just a little bit by making the benefits a little bit richer, adding some more elements of cost to the plan, but to make them better, and it was able to attract more members, it's going to make more profit from doing that. So what I'm getting at is what I really see from the insurance carriers is not this big strategy to go out and figure out how can we jack up prices. And I know cost is out of control. I'm not denying that. I'm not here saying that people aren't seeing what they're seeing. I'm just simply trying to speak to what the economics would be of an insurance carrier, given this is how you're setting your prices. If I were the insurance carrier, my goal would be to drive membership. It wouldn't be to figure out how do I jack prices through the roof. It'd be figure out how do I find the sweet spot between increasing membership and managing the cost so that you can pick up your volume. It's the purpose of this is just to give you a way to kind of conceptualize where the insurance carriers are coming from. So as we look at these issues, both from a how do we educate our clients perspective, as well as even a political perspective, what's really under the hood here. So I hope this is helpful. The link to the calculator is in the post, and we'll catch you in the next video.